January 2021. Pandemic boredom. Stimulus checks burning a hole in everybody's pocket. A free trading app called Robinhood that made the market feel like a video game. A Reddit forum where guys traded screenshots of their accounts like trading cards. A guy in a red headband who called himself Roaring Kitty. For about 3 weeks, he was the most famous investor in the world. GameStop stock went from $20 to almost $500. Hedge funds got crushed. Headlines wrote themselves. For one moment, it really did feel like David was beating Goliath. I want to talk about what happened next, because the part nobody likes to talk about is what came after the headlines moved on. And the bigger thing I want to talk about is the difference between investing and trading. Because I think a generation of young adults learned the wrong lesson from January 2021. And nobody's really cleaned that up since. My name is Kyle Blackwell. I'm a certified financial planner, and I've spent almost 2 decades sitting with families working through their money. And alongside that work, I've started building something called Purpose Path, a financial stewardship program for young adults. Before I say anything else, I want you to know where I'm coming from. I love markets. I bought my first stock when I was in middle school. In high school, I was reading Kiplinger and Barron's for fun. In college, I co-founded an investment club at my school. I've been doing this work for almost 20 years. So when I'm about to push back on day trading and meme stocks and the whole 2021 hangover, I'm not doing it as somebody who doesn't get it. I'm doing it as somebody who loves the market and has watched it chew up a lot of people who treated it like a casino. There's a difference between investing and trading. And the better you can tell those apart, the better the next 40 years of your life are going to look. Let me start with the simplest distinction. Investing means buying a piece of a real company because you believe in its long-term growth. When you buy Apple stock, you're not betting on a number going up tomorrow. You're saying, this company makes things, employs people, generates profit, and will probably continue to do that for the next several decades. You buy, you hold, the company grows, your share grows with it. That's investing. Trading is something different. Trading is trying to buy low and sell high over and over. Get in, get out, beat the next person to the trade. It's high stress, highly emotional, and statistically, most traders lose money. 80 to 90% by some estimates. Read that again. 80 to 90% of traders lose money. That's not the kind of statistic you see on TikTok, but it's the truth. When you're trading instead of investing, you're not really investing. You're playing a game where the odds are stacked against you, and the people who built the game are the ones taking your money. There's a saying I like. Your money is like a bar of soap. The more you handle it, the less you'll have. In the old days, if you wanted to make a trade, you had to call a broker. The phone call itself was a natural pause, a chance to think. Now you tap a screen. Buy, sell, buy, sell. Apps gamify the whole thing with green confetti animations and notifications and celebration sounds. That's not investing. That's gambling with extra steps. Let me tell you a story. Jesse Livermore was the original day trader. 100 years before Roaring Kitty, before the apps, before Reddit, Livermore was making fortunes by reading the market and timing his moves. In 1929, when the market crashed, Livermore made over $100 million by betting against it. In today's money, that's around $1.5 billion. He was the most famous trader in the world. Newspapers called him the boy plunger. He felt invincible. He had the touch. Here's how the story actually ends. I want to handle this part carefully because it gets heavy, and suicide is a real thing in real lives. He spent the rest of his life trying to recapture that one big win. Year after year, he kept trading. Some wins, more losses. His marriage fell apart. His health fell apart. By 1940, he had almost lost everything. He took his own life in a hotel in Manhattan. The note he left said, "My life has been a failure." Read that again. The most famous trader in the world, the man who shorted the 1929 crash, he died convinced his life had been a failure. Why am I telling you this? Because almost 100 years later, the cycle is still running. The apps are different. The vocabulary is different. But the underlying pattern, the chasing of one more big win, is exactly the same. If Jesse Livermore couldn't outrun it with billions in $1929, what makes us think we can outrun it with a Robinhood account in 2026? I want to be honest about 2021. I'm not going to make fun of anybody who got pulled into GameStop or AMC or any of the meme stocks. I get why it happened. There was a pandemic. You were stuck inside. You had a stimulus check sitting in your account. There was a Reddit forum full of people who looked like they were having the time of their lives. The whole thing felt populous and exciting, and like maybe, finally, the regular guy was going to get a win against Wall Street. I get it. but I sat with people through what happened next. The early wins, the screenshots, the way some folks doubled their money in a week, and then the turn. The stocks started dropping. Some people doubled down, hoping to break even. That made it worse. A lot of folks ended up with maxed out credit cards, loans they shouldn't have taken, and that sinking feeling of what just happened to me. If that was you, I don't want you to leave this video feeling stupid. You're not stupid. You paid what some people call a dumb tax, tuition for a real-world finance degree. You learned something important about yourself and about how markets work. And you can use that lesson for the next 40 years. You're young. The best time to rebuild is right now. But what I don't want is for the lesson to get lost. The lesson isn't, that one didn't work. Let's pick the next one. The lesson is, the whole approach was wrong. Trading and investing are different games. You were playing the wrong one. So what does actually work? I'll tell you, but I want to warn you up front. It's boring. It's not exciting. It's not going to make TikTok. I may force it on TikTok, but I don't know how many likes it'll get. Nobody's going to retweet it, but it's the actual answer. And 20 years of doing this work has only made me more sure of it, not less. Real wealth building is slow, steady, and quiet. 3 principles. 1, invest in things you understand and believe in the long term. If you can't explain to a 15-year-old how the company actually makes money, don't put your money in it. That rule alone would have kept most people out of most of the disasters I've watched. 2, automate your contributions and use dollar cost averaging. That's a fancy phrase for putting in the same amount of money every month, no matter what the market is doing. When the market is up, your money buys fewer shares. When the market is down, your money buys more shares. Over time, the price you paid evens out, and your stress level stays low because you're not trying to time anything. And 3, keep your fund money under 1%. If you really want to play with crypto or meme stocks or angel investing, fine. But cap it at 1% of your portfolio. If it 10x's, great. If it goes to 0, you barely notice. The other 99% is where your future actually gets built. Boring works because boring compounds. The math on compound interest is brutal in both directions. But if you give it time and stop messing with it, it becomes the most powerful force in your financial life. The problem is that in a world of 15-second videos and instant gratification, slow looks like losing. It isn't. People you see online claiming they got rich in 3 months either lost it back 6 months later or were lying about how much they actually had to begin with. The actual rich people I've sat with over 20 years didn't get there by trading. They got there by buying steady investments and not selling them for a long time. I want to close with the part that nobody else is going to say to you about this. If you're a Christian, your money isn't yours. I don't mean that in a guilt trip way. I mean it in the freeing way. You're a steward. God owns it. You're managing it on His behalf. Now ask yourself, if you actually believed that money was on loan to you from God, would you treat it like a poker chip? Would you put it on red because some guy on Reddit said red was about to hit? I don't think so. A steward is careful. A steward is patient. A steward asks, what's the wisest thing I can do with what I've been given? And here's the gentle thing about that posture. It's not just better theology. It's a better strategy. The behaviors that come out of stewardship, patience, humility, long-term thinking, contentment, are exactly the behaviors that build wealth in the real world. The cycle that took Jesse Livermore down was the cycle of a man who couldn't be content. The cycle that took a lot of 2021 traders was the same, restless, always reaching for the next big win. Stewardship is the off-ramp from that cycle. You stop reaching because you don't have to reach. The game you were playing was never the right game. So here's what I want you to take from this. Investing and trading are different games. The market rewards the boring stuff and punishes the exciting stuff almost without exception over a long enough horizon. If you got burned in 2021 or 2022, you didn't fail. You just learned a lesson the expensive way. And the lesson is worth keeping. Slow down. Buy steady. Hold on. Stop watching the screen. That's how this actually works. I wrote a book called Purpose in Every Paycheck that walks through how to think about investing as a Christian, including the chapter where the roaring kitty story shows up in print. Links in the description. If you lead a church or campus ministry and you want this kind of teaching for your young adults, the Purpose Playbook course covers it in the same direction with a workbook and a facilitator guide. Same link. Thanks for being here. I'll see you on the next one.